Hello and welcome to the Global View on this Friday. I'm Andrew Gagan. Good to have you with us again here at AusBiz. So let's take a look at what has developed overnight. In fact, earlier this morning, President Trump unveiled a plan to slap reciprocal tariffs on every country that has duties on US imports. And earlier, global stocks climbed while US Treasury yields tumbled as a measure of producer prices fueled optimism that the Fed's preferred measure of inflation may be cooler than anticipated. Well, the major US indices gained, led by the mega caps, including Tesla, Nvidia and Apple. Chevron shares rose after the oil major said it will lay off up to 1/5 of its global workforce by the end of 2026. Trade Desk shares slumped after the ad tech firm forecast first quarter revenue below analyst estimates. And MGM Resorts shares surged after the casino operator beat fourth quarter profit and revenue estimates. Well, President Trump has laid the footing for an all-out global trade war, unveiling a plan to impose reciprocal tariffs on every country that imposes duties on US imports. Targets include China, Japan, South Korea and the European Union, with the president saying he hasn't ruled out a flat global tariff. Saying, on trade, I have decided for purposes of fairness that I will charge a reciprocal tariff, meaning whatever countries charge the US, we will charge them, no more, no less. Australia and the US have a free trade agreement under which most tariffs have been reduced. Now, elsewhere, US producer price data has indicated that core PCE inflation, which is the Fed's preferred measure, is likely to be lower than previously expected for January when it's released later this month. It came despite producer prices rising more than expected, up 0.4%, but key elements of the core personal consumption expenditures index were benign or lower. And the data saw US rate futures pricing 31 basis points of easing this year. The US 10-year Treasury yield sliding around 9 basis points to 4.54, while the 2-year was down to 4.31%. And the US dollar slipped and then fell further after President Trump unveiled his tariffs plan. The Aussie higher at 63.2 US cents, and Bitcoin is trading around 96,500 US. Oil prices, a little change, pairing losses of more than 1% earlier in the session as a potential peace deal between Russia and Ukraine has developed. Brent crude futures at $75 a barrel. Copper's up 1.5%, while iron ore's fallen about 1% to $107 a tonne. And gold climbing to around $2,930 an ounce as those tariff plans heighten global trade concerns. So, to get across what we're seeing moving markets at the moment, I caught up earlier with Peter Cadillo from Spartan Capital.
Well, right now the market is still resilient, and I think the fact that today Trump reciprocal tariffs, but he basically gave it time. I think it's maybe a month and a half away. I think the time frame that I'm hearing is around April. So, I think what he's sending is a loud message to the world community that they need to talk and work out a deal with Mr. Trump. And so the market took that at heart, and it actually rose. And of course, we had some other factors. It does appear that Trump is likely to be successful in brokering a peace deal between the Ukraine and Russia. And then the other factor was that today we had the PPI number, and it was hotter than expected. But if you looked deeply into the report, there were some components that suggest maybe within the next 3 to 4 months, we might actually get a relief in inflation. Of course, that's not that excludes the prospects of tariffs if they do go into full effect.
So that we see that playing out, particularly in fixed income at the moment, as far as the prospects of a trade war, but also precious metals as well. How are you seeing the effects as investors are obviously concerned about this instability?
I like to think that right now the real smart money is really worried about the Trump's tariffs, and that's why we're seeing gold hitting record highs almost on a daily basis or every other day. In fact, today we did close at a record, and 3,000 is not that far away. And I suspect that that could continue. And this is all, based on the fact that smart money is thinking we really don't know what's going to happen with these tariffs, how they're going to impact the world economies, how it's going to impact inflation in the States, and even on a global basis. So I think, you need to own gold. If it pulls back, I think it's a good buy. And I thought we would see 3,000 by the end of 2024. Well, we didn't quite make it there, but certainly here we are, a month and a half in the new year, and we're just about $37-40 away from that new milestone, historic milestone of 3,000.
And Peter, how supportive Donald Trump's policies and what we're hearing from him for the US dollar at the moment?
Well, look, I think the US dollar remains firm. If you look at the dollar index, it's basically been trading within a cent and a half, 2 cents, but it's pretty much near the highs, and I think that will continue. Why do I think that will continue? Because if the tariffs should backfire and should ignite inflation, that means yields are going to go higher, and that means it will favor the U.S. currency. And also because of the fact that the fundamentals in terms of macro growth is still quite strong here in the United States. Now, I guess you could make a good case that perhaps the labor market within 2 months or 3 months is likely to weaken from these levels. And that's probably due because of, two factors here. If you look at corporate America, there seems to be more and more layoffs. And certainly if you look at the government layoffs here in the United States, they are beginning to be massive. And that means that those people are going to need to look for new jobs. But in the interim, that means unemployment claims could go skyrocketing within the next few months.
And Peter, what about in the energy sector? What are you seeing there in regards, well, once again, reaction, I guess, to what we're hearing as far as tariffs are concerned, but also with sanctions on both Russia and Iran?
Yeah, I don't see oil prices doing much of anything. I don't see them collapsing from these levels, but I don't see them going much higher. I think they stay within this $72, $75, $76 range. The big question is sanctions. The big question is demand. And look, OPEC has taken a back seat and said, we're going to monitor the situation. We're certainly not going to raise production at this time. And by the way, according to the new administration, there's going to be a lot of more drilling. And so that means more oil on the market. I'm referring to U.S. drilling.
That is Peter Cardillo from Spartan Capital out of New York. Well, for another perspective of what we're seeing, particularly statesides, in the wake of what we're hearing from Donald Trump, I caught up with Brad Gasworth from Unearthing Opportunities.
Yeah, I mean, you're right on there, Andrew. Front and center. It seems like a daily basis we get more commentary from this president, and ultimately it remains to be seen what the impact will be. I mean, we're paying very close attention to inflation, and if you have these tariffs and prices come in higher to the United States, at some point these companies will need to raise prices to the end user, and that's a concern because prices are already moving higher as we speak. So the most important thing is, will this have a bigger impact to inflation? If so, that might rattle the markets. But yeah, I mean, every day is not dull, to say the least.
So potentially, obviously, increasing those inflationary pressures, how's that likely to translate, particularly as far as corporate earnings growth is concerned, given the state of the US consumer?
Yeah, that's a great question there, Andrew. I mean, we have to really look into the different, where companies are getting their resources from. So if the companies previously get more materials from, let's say, Canada or Mexico, that's going to have an impact for sure. If they do not go ahead and increase prices to offset their increased costs. So, I mean, again, it's a little bit early to see what the financial impacts will be. Ultimately, the stock market has sort of shrugged its shoulders and blown off these initial commentary for the first couple of weeks when we've heard it. But it's something, I mean, we can't ignore it. Ultimately, prices will go higher. It will hit, companies' balance sheet or income statements. But if they actually do pass it, they can make up for it. But will they? That's the big question.
So, in fact, we've got the latest read on inflation in both consumer and producer prices. What have you made of those?
Yeah, I mean, I still think, I think the Fed's going to pause based on the recent outlooks. I don't see them making a cut this next meeting. Ultimately, I think we're going to have to pay very close attention to this, and then also just purchasing in general. So, in the States here, the consumer seems resilient because there's a lot of wealth that's been created on the crypto side. But there's some big concerns from layoffs. So I'm also concerned about the job market because I think it's a lot worse picture than what is maybe presented overseas. And I think it's getting to be a little troublesome because the largest companies here in the United States are certainly cutting back.
What have you made of the earnings results that you've seen most recently, Brad? I guess with a focus there on those megatech AI-related stocks in the wake, of course, of that turmoil we saw last month off the back of DeepSeek.
Yeah, and this is a great question here, Andrew. I think, when we had the companies report, this was, those results were before that DeepSeek was, sort of introduced. The numbers have been pretty good. I mean, looking at Microsoft, the AI growth was solid on the Alphabet side. I mean, you had a little bit concerns on like some of the Outlook commentary, but ultimately the AI growth and AI related companies are certainly putting up numbers up and to the right. Some of them did not hit the highest expectations, but they're moving in the right trajectory. So, I think we're still, we're very early in the whole scheme of things in terms of the infancy of AI and how many iterations there'll be. One of the biggest concerns I have with DeepSeek is, if we really do need or don't need to buy the highest priced, highest margin chip from NVIDIA, and, DeepSeek claims to say that they've created that, their interface with less than like $10 million or $20 million. Meta just announced they're spending $50 billion they're going to spend on AI. So if they're able to do it in the tens of millions and not the tens of billions, that's a concern for sure for NVIDIA. But ultimately, there's still many questions that are unanswered. I think it's too early to really just shoot and kill. I think we have to do a little bit more research, but all the numbers on the AI side, nothing has suggested a slowdown.
Meanwhile, Elon Musk seems to be, he's got a few distractions at the moment, obviously running the Doge department, but also making a pitch for OpenAI. What did you make of that?
Yeah, it is actually humorous to some degree. Obviously there's some bad blood between Sam and Elon. The number itself is a little bit interesting. So it's like a roughly 95 billion number that Elon sort of side mentioned to Sam that he'd buy OpenAI for that 95 billion. Just recall, OpenAI just did a raise recently with $157 billion valuation. So, that 95 that seems incredibly high is actually a 50% plus discounted what they just raised at. So I don't take it credible at all. I think it's sort of, these two that are sort of pushing back against each other. I don't think you're going to see the company for sale or any major change. I think they want to keep it the way it is. But to your point, there's no shortage of information when it comes to Musk.
That is Brad Gasworth from Unearthing Opportunities. All right, we are expecting a very solid open when we get underway. SPI futures up close to 1%. Stay with us because the open is just around the corner.